Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Wednesday, August 7th, 2024. In today's episode, markets, if you woke up this morning and saw the markets, you were probably like, oh, thank goodness, people are buying the dip. And they did, and they got crushed. It turned into a lot of engulfing candles. I'm just going to say here, if this was the bounce day, this was a weak bounce day. And it's highly expected, by my opinion, for this to continue selling off here. The idea is that Japan came out overnight, and basically I was talking about, if you remember yesterday, there's no fireman. So the fireman came last night and said, hey guys, we're not actually going to raise rates. We're seeing how it's going to blow up the entire world economy by raising our rates by only a tiny bit. I mean, think about how fragile the whole world economy is right now if the US stock market is crashing because the Japanese central bank is raising their interest rates by a little bit, or threatening to, or saying that they're going to. Wow. Again, be careful out there, folks. So we had a lot of engulfing red candles today, looking very bearish indeed. We'll go through charts and that kind of thing later. I just wanted to do a little special episode on how one might be able to use options contracts to protect one's portfolio. What we're going to do is we're going to do an example of a $1 million account invested in SPY, an index fund that represents the S&P 500. Currently, SPY is, we're going to call it just for easy sake, so the numbers don't get too complicated, $518. So we're going to take our $1 million account, we're going to divide it by 518. So we are going to say we own 1,930 shares of SPY. This number isn't super relevant to this example, but it can be helpful in determining how many contracts you want to buy to protect yourself. So I chose sort of a random number to protect ourselves with. We're going to sell 0.5% of our shares of SPY, which is $5,000 worth of that amount. So 0.5% of 1 million is $5,000. Now I just want to note that, if you have $1 million account in the S&P 500, a 0.5% move in one day is very common. In fact, we've had recent moves of indexes moving as much as 4% in one day. And so 0.5% is a relatively very small amount of money if you think about it for a $1 million sized portfolio. Now, our example is we're going to expect a 30% decline in the price of SPY over the next 3 months, and we don't want our $1 million to lose $300,000. So we'll go, and just a disclaimer ahead of time, we're not going to save ourselves in this current example with the current numbers of today $300,000 of losses with only $5,000. But I'll go through the example anyway, and you can calculate this is just a random example of a random day. It's not so random because the market's kind of crashing right now. And I'll say ahead of time too, the price right now of the options contracts is way elevated because of the volatility. I'll continue and try to make it as little confusing as possible. So what happens if I buy options with a strike price representing 20% decline? So in other words, I believe that the market's going to decline 30% over 3 months, and so I want to buy contracts that make money after we go down 20%. So when it goes from 20% down to 30% down, that's when this $5,000 really blows up in its value to help protect my $1 million account size. So first of all, we're going to start with saying, well, what is a 20% decline? A 20% decline of 518 of today's price is about $415. And the cost of those put contracts today is $368 per contract. And here it is. Here's the puts. The for SPY for November 15th, this is 3 months out, and I highlighted right here for the $415 strike price. The last person that purchased one of these contracts bought it for $368. Again, it went up by 27% just today, by the way. So it was cheaper yesterday. It went up in price, and we'll show you how extreme it really got and can get in a moment. So $368 for today, representing 100 shares. So that $5,000 that you want to use to buy these contracts, each contract being $368, means you can purchase yourself 13.6 contracts. Normally you can't buy partial contracts, but we're just going to use it for the example because, yeah, that's how we're going to do it. So in order for you to not lose any money, and you buy these contracts today, you hold them all the way till November 15th. If you want that to be still worth $5,000, then SPY actually has to drop all the way down to 412. Now, if it does drop to 412, then on that day, November 15th, the intrinsic value of those contracts is still worth $5,000, the $5,000 that you paid for those contracts. Now, mind you, as well, that doesn't include premium. It's actually going to be probably more than that if the price is that close to it, because there's all these levers involved with the price. You would probably sell it for much more than only $5,000 if it actually got to that price. But officially, taking the intrinsic value of it, if it gets down to 412, that's the break even. That means you didn't win, you didn't lose. Now, a 30% decline from the current price of SPY of 518 is $362.60. So now let's say it does drop 30% as you expected. November 15th, the SPY will be 30% lower than it is today. So that means if on that day you do this and it's 30% lower, well, the intrinsic value, not including premium, mind you, again, is that 412, the break even minus the 362. So your net profit is $50 per share represented by the contracts. Now 13.6 contracts represents 1,360 shares because it's 100 shares per contract. So your intrinsic value profit ends up being the number of shares represented times $50.08, which comes out to $68,108. Now, remember, I said you have your $1 million. It went down by $300,000, but that $5,000 ballooned up to $68,000. So it didn't balloon up to $300,000. It didn't fully protect you. So obviously right now, the cost of protecting your account is more right now. I mean, 68, it's like 3 or 4 times as much, right? So then 0.5%, you're looking at 2% of your portfolio today to currently get that protection. The last thing I want to point out is that the price of these contracts can vary massively. They can go way up and way down. The further away you are from that expiration date, November 15th, the more up it can go and the more down it can go if it's going your way or against you. And just to show you this, it was July 31st. These contracts were selling, if you can see to the right of the screen, $102, so $102. So they were costing less than 1/3 of the current price. Now remember, I said if you multiply this by 4, then you would protect yourself against that $300,000 loss. Now it would have only cost you $5,000 to get that protection. Say you bought those contracts last week on Wednesday, 1 week ago, at 102. And I mean, even if you go further back, the lowest it got was $82 a share. And mind you, the cost of these contracts was as high as $758 a share just yesterday. So they've actually dropped. Is this? Yeah, this is correct. I'm not sure why it says plus 27%. It might be an error, but yesterday's candle, clearly the high and the open was at 773. It says dollars per contract, and today they're only $368 per contract, while SPY itself, today had only dropped by 0.67%. So the numbers get a little complicated. So it went more to your direction, but it lost value. Are these numbers right? It looks like nobody traded it today. So this was actually yesterday's price of 368. Yeah, it even says here August 6th. So nobody traded this today. Nobody bought or sold any of these contracts. But yesterday it was that price. So you get the gist of it. And the day prior, the huge, massive flush out of markets 2 days ago, it was priced as high as $766 per contract. So as you can see, the price of these contracts can double in one day when the price of SPY moves by only a few percent, because it's longer dated out, and the more volatility that's expected in markets, the more people pay for these exact contracts, the more premium they're going to have on them, and it has to do with how far they are away, and so that's I wanted to walk through an example of how investors can use options contracts to hedge themselves. That's how these things were originally conceptualized and designed to work, as a way of basically buying insurance on your investments. So that finishes that segment. We're now going to go through the rest of today's charts. So to finish up my notes for the day real quick, again, tomorrow, Thursday, initial jobless claims comes out. It's expected to be 9,000 jobs peachier. In other words, less people filing for initial jobless claims. I, with my crystal ball, kind of think this might be another canister waiting to blow up. There's still a fire. If this comes out like very favorable, I'm not sure that'll put the fire out, because this number doesn't typically have huge weight on how markets act, unless it gets really out of control. Then yeah, it turns into a canister that explodes, right? But anyway, next Tuesday and Wednesday also that is the next real data that's coming out, with CPI and PPI on Tuesday and Wednesday, which could really rock things. I mean, say CPI is higher than expected, and then the Fed funds futures no longer is pricing 2 cuts while the market is tanking. I mean, think of this. Before, it was every time we were expecting more cuts sooner, the markets loved it. It's like candy, and the market is just eating it up and going up on, oh yeah, that's going to cut, they're going to cut. So now what they're saying is that the next meeting is expecting a 50 basis point cut, and that's not enough. The bears are taking over this market right now. These are epic times. Don't forget, daily reminder, 2-year, 10-year yield curve inversion is still past its second birthday. We have not uninverted yet, and when we do uninvert, it's typically like the recession. So watch out for that. We are headed in that direction as well. Also, SOM rule has been triggered, saying that the recession is basically here. The unemployment rate is going like this, and yeah, it's adding fuel to the fire. Speaking of SPY, SPX, another way to look at this. It's the trader's preferred way of looking at this. Like I said, we opened way higher. It was like, oh, people bought the dip. The Japanese carry trade, Japan saved the day. They came in and said, no, don't worry, guys. You know what? We're not going to hike. We're not going to blow up the markets. Oh, man, the market loved that. But it didn't last even a day. We crashed and engulfed yesterday's full candle. This is very bearish looking. This is not candle to be reckoned with. VIX futures term structure fully inverted still. Taking a look at the VIX, we are still at what you could call an inside day. This candle still being inside of Monday's gigantic green candle here. The market is still on fire. The fire did not get put out. I bring up TLT only because of how highly exposed I am to basically leveraged versions of this, with more than, like 55% of this of my portfolio is in this now. It declined today with a little doji. This can be a reversal. This actually could be a bottom, and we could go up from here, or we could get back down to the, this major trend line was the inverse head and shoulders that we broke, and so it would be highly normal and usual to retest this line and for there to be a lot of buyers waiting here to send it soaring even higher. High yield corporate showing unusual strength is what I would call it, but I would also like to note that the bottom of this candle where we closed today is not very bullish looking. It's a semi-large red candle engulfing Friday's candle and closed actually lower than these past weeks dating back to July 11th, and so I'm still holding those contracts. If you heard me talk about those, I have contracts that expire Friday for $77.50 put contracts on HYG, and I think they'll print. We'll see. I noted, I think it was yesterday, pyinvesting.com's version of Fear and Greed, their way of looking at this, and I was astounded at how it was still 100% in stocks and showing fear. And today, I don't know where is it getting this? It says it's in greed mode now. I don't know if it's not working or something, but the index is finally moved to 90% stocks and 10% cash. So we're going in that direction. This longer moving, slower moving thing is finally starting to curl over. There's enough volatility that this thing is seeking it out here. And Fear and Greed Index on CNN, extreme fear still. Again, I wanted to note the September 18th Fed funds, Fed meeting went from a 63% probability of 2 cuts to a 71% chance of 2 cuts today. So the chances of 2 cuts actually increased today while the market went bearish. This is not a good sign for stocks. This spells out that it will continue down from here very confidently. Again, the inverse of TLT, I mentioned, the head and shoulders. This is the actual head and shoulders because it's the inverse of TLT, and how we're basically going right up to that line. It obviously wants to get there. I won't be surprised at all if Treasury yields rise up to the line and get rejected. I expect lots of buyers of Treasury bonds to be waiting here. I'm considering the circumstances. I still have about a 13% cash position, I believe, right now. I might put the rest of that, now that I'm thinking about that, in 0Z tomorrow myself, which would put me around 65% in long duration treasuries. Wood leading indicator also engulfing candle. In other words, it opened higher than yesterday's open. It closed lower than yesterday's. Well, you know what I mean. The open and close opened and closed from higher to lower. So this is an engulfing red candle, very, very bearish looking. SMH, same thing, at least from yesterday. Now, to confirm even further downside, we want to see, closing below Monday's candle, going even bearish, but at this point it's very highly expected from my perspective. Even in Bitcoin, this is Bitcoin miners engulfing candle. I just wanted to emphasize all these engulfing red candles here. You know, they all did the same thing. We opened high, the buyers came in, they said, oh, Japan's cutting their rates, so now the market's saved. The fireman came because that's what made this sell-off happen in the first place, right? That's what set off the spark. That was the spark that blew it up, right? Well, I mean, we had the SOM rule that just got triggered. We have Fed funds futures preparing to cuts. This is like the fire's burning, and the fireman didn't put it out. Triple Qs, the Nasdaq, same thing. Yesterday's little green candle, again opened like blissfully today, so much higher, and then the bears just drove it down way below there. That's all I have for you for today's show. I hope you enjoyed. Thank you for watching. Be careful out there, folks. It's getting a little smoky. Robschild.